Hello there. This is Bruce at Fleet Capital Management. It is Friday afternoon, the 16th of May. Markets closed. We're going to take a look at what happened this week, and quite a number of things have changed on our technical outlook, but we'll jump right in. We always start by saying that the video presentation is intended for educational purposes only, and the discussion of any security is not a recommendation to purchase or sell the security. Please feel free to contact me whenever you have a question, Bruce at Fleet Capital Management. Last week, I showed you this chart of the S&P, and I said there were some areas of resistance that we would have to break through first. In a couple of minutes, when we get over to the charts, just remember this, and I'm going to show you where these levels were on the charts. Okay. Interesting thing happened today, not good. Moody's downgraded the United States credit rating, which means now all three credit rating services have downgraded the U.S. credit rating, and they are citing growth in government debt, which is obvious. The importance of this, I want you to think about your own credit rating. If you have a very high credit rating, you get very low interest rates when you go to borrow for things, for a car, for a home. The higher your credit rating, the lower the amount of interest that you have to pay. It's exactly the same thing for a government. The higher their credit rating, the lower the amount of interest that they have to pay when they issue treasuries, which is pretty much how they fund the government on an ongoing basis. So this is just one downgrade, but downgrades are important. And I wouldn't be surprised if we see further downgrades. I hope we don't, but let me show you something else here. America, as you know, is a consumer spending based economy. We are not a manufacturing economy. We're really not a service economy. What drives the United States economy is consumer spending. Okay, keep that in mind. Recent data indicates that consumer spending has been slowing down across the board. This slowdown is noticeable across different income levels, with lower income households experiencing the most significant deceleration in spending growth, which is obvious. That makes sense. And consumers are increasingly cutting back on large discretionary purchases and are becoming more cautious with their spending habits. Okay, what does this mean? Well, it's not good for the US economy because we are a consumer spending based economy. Why is this happening? Well, right when tariffs were first introduced, one of the things I told you was the stock market hates uncertainty. And that's kind of a broad statement. And what that means is businesses hate uncertainty. If you're on the board of Walmart, Costco, any of these US based businesses, and you don't know what your tax rate is going to be, you don't know what your interest rate is going to be, you don't know what the tariff amounts are going to be and how you need to price your goods, that's uncertainty. And it also drops down to the consumer level, to our level. If we're uncomfortable and we don't know what's happening with tariffs, with interest rates, with the economy, is there going to be inflation? Is there going to be a recession? Is there going to be stagflation? The very smart thing to do as a consumer is to pull back, spend less money. Money in the bank is safety, but money in the bank doesn't fuel our consumer-based economy. So all of this is tied together. We are not at a crisis level, at least I don't believe we're at a crisis level. There are others, Warren Buffett included, who believes we are in a crisis. Warren Buffett, in a recent speech I read just a couple of weeks ago, he said, if America were a company, I wouldn't buy it. I wouldn't be interested because they're insolvent. They have more debt than they have income. I mean, that's Warren Buffett. So this has got to be fixed. The way you fix this is you raise taxes and lower spending on a government level. That's how you do it. That's how you do it. It seems like in the GOP spending plan, which they haven't even been able to pass their own plan, they are cutting taxes, especially for the wealthiest Americans. And that's exactly what they did in Mr. Trump's first presidency, is they cut interest, not interest rates. They cut taxes on the wealthy and taxes on businesses, and our debt exploded. You only have, it's a ledger. I like to really make things simple in my own mind. It's a ledger. It's the same thing that we have in our own homes. We know how much income we have coming in. Know how much debt we have going out. Real simple. If you have more debt than income, you're in trouble. And if you eventually can't pay your bills, you're really in trouble. So governments are similar but different. They can always pump out more dollars, they can create more money, but that is also very inflationary, as are tariffs. So I would say it's not a disaster, but I would say that we're in a precarious situation. Single most important thing to know for us is whether the market's going up or down. Everything follows from there. So let's take a look. Here's our matrix updated through today. In the weekly, excuse me, in the daily column for the S&P, we've been in an up situation for quite some time. We've been bouncing around in the weekly on volume and momentum. We went from down, which is where it was for quite some time, to mixed to back down. We're back up to mixed. Okay. But at least we've got an uptick. Over here, which is the 2 week moving average over the 10-week moving average, we've gone up. I don't know why that's yellow. That should be green. I'll change that in a minute. But we have gone to up. On our moving average stack, remember, we want to see the 20-day moving average higher than the 50-day and higher than the 200-day. That would be a bull market indication. It has been the other way around. The 200-day has been greater than the 50-day, and the 50-day has been greater than the 20-day. That is a pure bear market stack or situation for moving averages. It has changed this week to where we're still below the 200, but now the 20 is over the 50, which is a very good sign. But as long as we're under the 200, it's still yellow. It's not green. Our bear market avoidance indicator is still in the red, which means that the 10-week is still below the 20-week. That needs to change. The VIX, let's talk about the VIX, the fear index, has been red for a long time and it's gone down into yellow, which is between 17 and 20. But today we close at 17.24. We're a quarter of a point above being able to switch this back to green as well. So I would suggest to you there are a lot of things in here that have gotten better. This is not perfect. Perfect would be green across the board, but it has gotten better. Because it has gotten better, and we'll go over to the charts. For most accounts, I added another growth-oriented ETF. It was FFLC. We've owned this before. We've made good money with this investment. We bought it on where you see that vertical dash and this horizontal, where those two meet is exactly where we purchased it. It is up. Nothing to write home about, but it is up already. We've only owned it for 2 days. We like that. I have this box created because there is a gap in price. And all you need to know about gaps is they tend to be filled. It doesn't have to happen right away, but if we see some weakness over the next couple of weeks, I wouldn't be surprised if price comes down, fills that gap before resuming an uptrend. The 20-day moving average is clearly above the 50-day. That's a really strong sign. That was another reason I added this. And the price is above that red line, which is the 200-day moving average. So even though our moving averages are below the 200, I still felt there were enough positives to add that back in. Our momentum is strong, volume is strong, our RSI is strong. So there were enough things that were showing up positive to add it back in. The volume has not been strong. That does suggest there could be some weakness. But again, in an environment that we're in, we're not going to get perfect. We're not there yet. So anyway, I did add this back in. Depending on what happens next week, I've got another growth ETF that I'm planning on adding to the portfolios as well, but we need to see. Let's go back to the S&P. Remember I said kind of put a pin in where that resistance level was. Well, that resistance level was right, excuse me, the one we were looking at was right here. Whoops, went the wrong way. It was this line, which was last week was red, and now it's green. Red means it's an area of resistance like this one. Green means now the price is above, it's turned into an area of support. These things change. If the price goes above this level of resistance, this line will automatically turn green. So this was, let me move this over a little bit. This was the resistance that we were talking about last week, and we have broken through that. And that is another reason I added FFLC, which is it's not conservative, but it's not a pure growth. It's more of a large cap blend between growth and value, which are both present currently in the markets, and it's rated more conservative than pure growth fund. But this is important. Now, if the price comes back down, I don't want it to go below this green line, which is now support. Okay, but we do have a gap here, and gaps tend to get filled. We never know when. But again, there were just more bullishness than bearishness, and that's why we're adding. Over on the weekly chart, you will see we broke through these two blue lines, which were areas previously, they were areas of resistance. This is last week. This one is this week. We've broken through both of those. We have another one up here, which is another area of resistance, and that corresponds on the daily chart with this red line. Same kind of area resistance, same, pretty much the same area within a couple of points. So our momentum is turning up on the weekly. It's not great. Our volume is turning up on the weekly. Not great, but good. The RSI is above that 50 line, which is really good. Love to see that. And the MACD it's like right at the center line. We want to see it cross up above, but we're so close. Again, this is why I made that move. And what I see in the markets early next week may prompt me to add even more growth to the portfolio. We're going to step into this a piece at a time because I just think that that's the right thing to do. Most of our investments have been doing fine. XLF that we're in, we went in it right there where that dot is, and it's significantly higher, and it just broke through this area of resistance, which is fantastic. I would love to see it continue. That bar is gray, which means there's some weakness in momentum. I would like to see that turn back green, but this is all good. We just bought this and we're up nicely. IBIT, for those of you who are trading Bitcoin with me, our entry was right there. It was kind of a perfect entry, if I say so myself. And we've had a nice run up. We had the first run up and then we went sideways. Remember, we go up, down, or sideways. We had a big run up. We went sideways. We consolidated. We had a big run up. We're now consolidating. And when you consolidate, you don't know if you're going to go higher or lower. There is an area of resistance up here. But I feel pretty good about Bitcoin. I'm not real worried about Bitcoin. Um, Gold. Gold has been having a very difficult time. This could represent what's called a double top, if you see that there. We've just gone down below the linear regression, which is a very bad thing. It can be, although we've gone below it before. This is a perfect example. We went below linear regression, but we held above the 50-day. And I'll bet you I had a stop somewhere down here. We have now gone below the linear regression. There's the 50-day, and here is my stop. This time it's a live stop. I don't want to give back all of our gains. If we get stopped out, this is a live stop, not an alert. We've already gone through the alert stop. So actually, I can even remove that. Well, I'll do that later. We'll remove that alert stop because I was alerted. Now it's a live stop. So if price comes down, breaks below the 50 and hits our live stop, we're out with a decent profit. We'll always just go back in if the indicators suggest we should. But with all of the indicators kind of pointing lower, I'm seeing kind of weakness in different areas. Not as much on the weekly, but I am seeing enough weakness that I've got a live stop in here. And if, like I said, if we get stopped out, we'll go back in because I like gold, and I think gold is going to continue to be strong, just like I think Bitcoin is going to continue to be strong. CTA has been drifting lower. I've got an alert stop down here. This is interesting. This is a little bit different than most of our investments because this is completely non-correlated to the US stock and bond markets. They're just having a difficult time, but it looks like if you see this, look how horizontal this looks. So between this area of resistance and this area of support, it's what's called a zone or a consolidation zone. I don't want it to break below this. It didn't the last time. It didn't yesterday, and that low was higher than this low. That's a positive. But I'm not sure. I'm not going to let this thing languish. Again, I've got an alert stop in right now. I'm not real worried about it, but it's only down 4 or 5%. But we'll continue on. We have Vault in most portfolios, which continues to rise. Once it hits its maximum gain for the 90-day period, remember, this is the 90-day investment. Once it hits that maximum gain, depending on how close we are to maturity, if we're far away from maturity, I'll just sell it and then buy into the next one. If we're really close to maturity, I'll probably just hold it through and let it roll over, which for taxable accounts can provide a better tax situation, especially if we can get to over 12 months. But I won't let taxes wag the dog. You don't let the tail wag the dog. If we hit our max gain and we're not close enough to the maturity, I'm going to sell it. And we'll deal with taxes later. I don't want to have it go up to max gain and then lose it. That's just a terrible situation. So I know we went over a lot of things. Everything looks good. We'll see if this market keeps plugging along. We did break that area of resistance. Next one's up there, but it's quite a ways away. And if I see some more strength next week, I will add yet another position of growth into our portfolios. And of course, we also have the defined outcome ETFs, some with no risk, some with some risk, but we're participating in those as well. So we're going to be fine. I'm not real worried about that. So with that said, have an enjoyable weekend. If you have any questions about anything, I'm always here. Just jump on the email or my calendar, my Zoom calendar, and we can talk about your situation one-on-one. I'm always, always, always available and happy to do that. And you know where to find that. My email, but if you go to the front page of our website, you can go right here and just get on my calendar. And again, if you have any questions, I'm here for you. Other than that, have a fantastic weekend, and I will talk to you and be back at this Monday morning. Talk to you soon. Bye-bye.